I think I've met most of you already, and probably at the launch of this cohort. This was, God, I can't even remember when that was, when I last saw you. Probably a couple months ago. But
That was the end of July.
End of July. Wow. Okay. So 2.5 months. A lot has changed, but a lot is the same, as in Melbourne and Sydney both being in lockdown since then. But I was just telling Sarah at the beginning of the call, I'm in Sydney, so things have opened up here, which is good. I'm just waiting for my second jab in a couple of weeks' time, and then I can make the most of it as well. So look, when this cohort was launched, and I got to have a chat to some of you on this call already. Just did a brief kind of overview of the typical services that you may need as a startup on your journey towards an IPO or an exit. And I talked about things from the beginning, support with government grants and ESOPs, and then possibly capital raising and audit, and then the IPO or exit later. What we wanted to do today was just a bit of a really wide and shallow approach into the different accounting and tax issues that you as founders should be aware of. You don't need to know the ins and outs of it. That's my job, but these are the ones in our experience working with founders and CTOs, and just the issues that regularly pop up. And things you should be aware of, some tips and traps. So then that way, if you come across it, you can say, oh, hang on, that's something I need to know. I need to have a chat to my accountant about it. So today is not a deep dive into any of these subjects. Believe me, I could easily spend an hour talking about R&D or ESOPs. It's, like I said, just a really wide and shallow approach, just to show you kind of the things that you should probably be across. I'm happy to take, because it's a smaller group, I'm happy to take questions and comments throughout as well. So just unmute, put your hand up, whatever you want to do. And we've got enough time to be able to have a chat about any of these issues today. Alrighty, so I'm going to share my screen now. Okay. Cool. Could I just have Sarah, could you just confirm if you could see my screen?
Yes, we can see.
Perfect. All right. So what we're going to do today. All right. So preparing your startup for financial success. And what we're going to be doing is just covering these different areas here today, and just spending a little bit of time on each of them as time allows. So structuring, employees, which is all about ESOPs, accounting, capital, R&D and government grants, and then some international expansion as well. Okay, structuring. Structuring, again, could easily spend a lot of time on it. I've only kept it to one slide because I just want to kind of drill down or drill in the key takeaways when it comes to structuring. Number one, and it's not even on this slide, but I'm assuming that you guys are operating your business through a company. That's kind of a given if you're a startup. So if you're not currently operating through a company and you're a sole trader or you're a trust, please have a chat to me afterwards, and we can see if we can resolve that. But the first point in there, so assuming you've got your company set up, how are you holding the shares in the company? The quick and easy way to do it is just to hold the shares through your own personal name. A lot of people do that. It's easy, it's simple, and you can get things off the ground and running. When it comes to best practice, and I'm going to be talking about best practice here a lot, okay? And it's up to you to decide whether to follow best practice or maybe, you're bootstrapping and saving funds, etc. Whether or not to follow best practice or go for something cheaper, again, that's your call at the end of the day. But best practice in terms of how to hold the shares in the company is to hold it through a family trust. And there's a couple of reasons for that. The first one is asset protection. So if for whatever reason the shit hits the fan and a debtor or a customer or an employee is coming after you as a director of the company, they can also come after assets that you hold. So if you hold the shares in the company in your own personal name, there's that exposure there. By having the shares in a family trust, it's just that one step removed, which makes it a lot harder for people to come after that. And the second key benefit of a family trust is it allows income splitting for tax purposes. So at the moment, a lot of tech companies, the typical play is they're loss making, they're not making a profit. It's all about customer acquisition. It's all about market share. And then they've got a big capital play in 5 to 8 years' time. That's the traditional model or pathway for a tech company. And then in those 5 to 8 years, or those first 8 years, you're not going to be paying dividends or anything like that, but there's a big capital play at the end. So then when you exit and you sell your company, when you sell the shares in the company, you're going to have a big capital gain. If you hold the shares in your own personal name, that entire capital gain is taxed in your own personal name, and the highest marginal tax rate is 47%. By holding the shares in a family trust, it at least it gives you the option of being able to distribute that capital gain or stream that capital gain to other family members. You could have a partner who's on lower income. You could have maybe some adult age children who are uni students and bludging and not really earning much income. Or you could have older parents who maybe just living off their super and they're on lower income too. It at least gives you that flexibility to distribute that income. And just to give you an idea of how much you can save, if you were to distribute $180,000 to someone who has no income, you'll save about $30,000 in tax there. So the amounts are quite substantial. The second point there is about protecting your IP. Now, the key takeaway from that is, how are you operating your company and your structure? Do you just have one company, or do you have a few different companies? Now, again, the quick and easy way is just to have the one company, and that's the one trading entity. It has the IP, it has the customers' contracts, it has your employees in there, it has the leases, basically everything. Okay. Again, that's the easiest way to run things and operate things. If we think about asset protection, it's similar to the first comment about family holding the shares through a family trust. What if someone was to sue the company? What if an employee was to sue the company, or a customer was to sue the company? If they come after the company, they can come after all the assets that the company has. And your most valuable asset is probably going to be your IP. So if you've just got one company there, that means your IP is potentially up for grabs. So the best practice in terms of protecting that IP is to have two different companies. So let's say up the top, you've got yourselves or your family trust holding the shares. You hold the shares in the top company there, call it IP company or holding company. That sole job of that company is to hold the IP. And then that company holds the shares in a subsidiary and call it trading company or operating company. Okay. And then all the activity is in that bottom company with the IP separated at the top. Now, if a customer or an employee was to come after the company, they can only come after the trading company. The IP is separate. And then what happens here is kind of a lizard's tail. You chop it off and the IP is still protected and it's out of reach of those people. Okay. So having that holding company, subsidiary company structure is very common, and we do recommend that. Other people take it to another level and have a different company for your employees, a different company for customers, etc. But we do recommend, if you could separate the IP out from everything else. Once you have that holding company, subsidiary company structure, the next thing you can do is group those companies for tax purposes and for GST purposes. And the reason you want to do that is, if you've got two different companies and you've got your IP up here, you're probably going to need like an IP licensing agreement or some other kind of agreement between the two companies, just from a commercial perspective, so then the right income and expenses can flow through between the two companies. When you consolidate the two companies for tax and for GST, it means you ignore those transactions for tax and for GST. So you're not going to have a strange outcome where one company is paying tax and the other one's not. You just treat it as one company, and same for GST. And then the couple of tips I've got at the end there is restructure into the right structure. The sooner you move into the right structure, the better. And the reason being is that whenever you're moving assets around, so if you want to incorporate a new company and move all your customer contracts, your employees, or move your IP around, or whatever the case may be, whenever you start moving assets around, for tax purposes, they always, or the ATO always assesses any amount based on the market value of the asset. So if one company is moving the IP to the other company, even though it's kind of the left hand talking to the right hand, for tax, it's all done at market value. So if you've just done a capital raise and you valued your company at $5 million, well, that IP is worth $5 million and you've just got a deemed disposal there. So that's why we say the sooner you can restructure into the right structure while the market value is still low, the better. Okay. If there is a significant or substantial market value attributed to your IP or anything else, there are concessions available. There are tax concessions, but it just means you've got to have a chat to someone like me or your accountant to see what's available to get the best outcome for you. And then the final tip on there is structure with the exit in mind. So look forward and think about what do your buyers want to see? What do they want to see in your company structure? Do they want to see the IP separated from the trading operations and maybe a different employment entity or customer entity, whatever the case may be? Structure with the exit in mind, because it just makes things a hell of a lot easier if you do have the right structure from day one. Okay. So look, those are my tips on structuring. If anyone does have questions, like I said, by all means, just hit unmute and ask away. Otherwise, I'll move on to the next topic. Okay, employees, ESOPs. Okay, incentivizing employees is really important, and you know this better than I do. Finding the right talent is difficult. Finding the right person is difficult, and especially now while the borders are closed, it's even harder to find that right person. So the way, part and parcel of being a tech company now is that you're expected to have an ESOP in place to attract, retain, and incentivize your employees. Okay, investors are expecting to see this, employees are expecting to see this, and typically we see about 10 to 15% of companies setting aside companies setting aside about 10 or 15% of their shares for an ESOP. Okay. And once an ESOP works, so once the whole point of an ESOP is to align the company interests and the employee interests. Okay, once that works, there's been numerous studies that have shown that it not only benefits the company, it benefits the employees, it benefits the economy as a whole. So there's lots of studies done that proves those points. So ESOPs, I'm going to start off with the things not to do or some traps to avoid before I move on to the tips. The first one is if you're trying to issue contractors with options in the company, there's a right way and a wrong way to do it. Okay. Contractors that are operating as individuals or sole traders, they can access a lot of the ESOP concessions, whereas contractors that are operating through a company or a family trust, they're not going to be eligible for a lot of the concessions. So there's planning that's required. So before you do that, that's something you need to have a chat to your tax advisor about. If you're a founder and you're trying to issue yourselves further options or shares, because you hold more, founders will hold more than 10% of the shares, straight away you're going to fall out of a lot of the different tax concessions that are available. So again, there's a right way and a wrong way to do that, and there's no cookie cutter approach to it. You just got to. It honestly just depends on each company, and again, that's something that you need to speak with your tax advisor about to find out what works. The other trap I've got mentioned there. Things not to do, promises made but not actioned until much later. So, and I can't tell you how many times I've seen that. Company comes along or company's incorporated, they tell their employees, yeah, we're going to give you an ESOP. Then years pass and now they're at the point of they want to set up the ESOP. Well, guess what? In those years, that company has gone from having a value of nothing to being valued $20 million. And being able to access a lot of these concessions has just fallen out the window. So I do recommend, I know obviously everyone's trying to bootstrap and keep their, as far as you can go. ESOPs is one of those things that you don't want to stuff up. Get it done, get it set up, because it's going to save you a lot of headaches down the track. Be very, very wary of using cheap or free ATO templates or ESOP templates. There's ones on the ATO. There's ones there specifically for the startup concessions. They are rubbish. Okay, you get what you pay for. That's why you need to have a chat to landers or to Aperian law as well. Speak to your legal advisor because you get what you pay for. I can tell you an example on the ATO template there. It doesn't distinguish between good leavers and bad leavers. So if you've given your employees options under those templates, if you fire them, there's a chance they can still hang on to those options. And then the other thing that we see companies forgetting quite a lot is there's annual reporting that needs to be done with the ATO for those ESOPs. It's similar to your PAYG payment summaries or your income statements. You need to lodge annual ESS statements with the ATO and provide a copy of those to your employees for any options or shares issued during the year. Okay, that was what not to do. Tips for setting up a tax-effective ESOP. First one is have clear vesting criteria. Easiest thing to do is just have a time-based vesting, 12-month cliff, options vesting monthly or quarterly over 3 or 4 years. It's simple, it's easy, and if your employee has been with you for 3 or 4 years, chances are you probably like them and they're probably good at what they do. So you're happy for them to have their options. As soon as you start getting tricky with basing it on financial measures like profit or EBIT or something like that, it becomes complicated. Having an appropriate exercise price, option exercise price. The point I'm making about that is if you can access these startup concessions, you can get a really favorable option exercise price. And by having a really low option exercise price, that's going to work out well for your employees. There's no point in setting up an ESOP if they have to pay thousands of dollars to exercise their options. I touched on it before about the ATO's templates. Good and bad leaver provisions. Make sure your ESOP plan rules clearly state what happens to those options to employees that leave because you fired them or employees that leave out of their own free will and they've been good leavers. Do you want them to hang on to their options? Do you want to buy back the options? Good and bad leaver provisions have to be in your plan rules. Okay. Accelerated vesting and a change of control. What happens if a buyer comes along and wants to buy your company? I've seen where ESOPs have been set up that either don't allow for a change in control, or if they do, their employees are stung with a big tax bill. So you need to consider those scenarios. And finally, it kind of goes without saying, the ESOP, like a lot of things, it needs to be tax effective. So if your company can satisfy the startup concessions, that is going to be the most tax effective outcome for your employees. And it basically means, for those who are not aware of it, is that the employees don't pay any tax on any options they're issued with. They don't pay any tax when they're issued with their options. They don't pay any tax when they exercise their options. They only pay tax when they actually sell their options or shares in the future. And the entire amount is under capital gains tax. So as long as they've held it for more than 12 months, they only pay tax on 50% of the gain. It's by far the most concessional type of ESOP arrangement out there. And if you can get into that, that's the one to go for. Okay. So that was ESOPs. Common accounting mistakes. Look, I know you hear accounting, it doesn't really float everyone's boat, but you need to, it's the typical analogy of the founder wears many hats. Okay, you've got your day job, you do what you do best. You're also your own accountant. You're of the business. You're the cleaner of the office. You take her out of the trash. Sales, finance, everything. Okay, you wear many hats. Getting the accounting right is important, and the reasons there on that slide is basically why. One, if you don't do it right, and it's going to take up your time that you could be spending on other more important things of your business, the things that you do the best. You won't be able to accurately assess your business performance. So if you don't know how your company's truly tracking in terms of budgets, in terms of cash flow and runway, how can you accurately assess how well your business is doing? And that follows on to the next point. If you don't have good current financials, how can you plan for future growth and expansion as well? If you get things wrong, mistakes often come out in the due diligence process of a raise or an exit. And it's not a good look when you present investors with your financials and them and their lawyers have just basically torn it to shreds, and it's just completely wrong. It's not a good look, and it can potentially impact your valuation and potentially even kill a deal as well. So the most common mistakes to avoid, most common accounting mistakes to avoid. Number one, I can't tell you how many times the company's cap table doesn't agree to ASIC and doesn't agree to zero. That is by far the most common mistake I see startups make. Okay, however many shares you've issued or raised, the amount you've received from your company, from your investors, that should be tying back to the shares disclosed in ASIC, and that should be tying back to the amount you've got in your reported in zero. Okay, again, same with options and safe notes and con notes. The amounts you show in zero should tie back to your cap table. Second point there is wrong revenue recognition. This is particularly relevant for SaaS businesses that bill subscriptions or licenses in advance. If you're billing maybe 12 months, 18 months, 2 years in advance, if you just show that whole amount as revenue, it's going to look really lumpy on your financials. So where you're billing annually in advance or multiple years in advance, you want to make sure that you show the revenue over the period of time, just to show that you've got steady growth and it's not lumpy. Investors don't want to see lumpy; they want to see they do want to see steady, even exponential growth. And then I've got a few payroll related mistakes there. Incorrect payroll categories for super and for ordinary times earnings. So certain types of payroll like wages and salaries, they're called ordinary times earnings, which means that super is payable on them. Okay. For other types of remuneration like allowances and bonuses, some types of allowances and bonuses are subject to super, some are not. So you want to make sure that it's been correctly set up for one, so then you're not underpaying your super to your employees, because the last thing you want is a super audit from the ATO. Those things are a pain in the ass. And two, you don't want to be paying super to your employees when you don't have to as well. The fourth point there, not tracking leave. So I'll give you an example on Xero. When you set up your employees, Xero tracks the leave for those employees, personal leave, annual leave, etc. But it doesn't automatically combine the leave into the accounts. That's an extra step you have to do. So again, by not having your provisions for annual leave and for long service leave in there, it's not giving you an accurate assessment of what the company's current financial position actually is. If you had an employee that's been with you for 10 years and they're entitled to long service leave and they have a bunch of annual leave stored up that you have to pay out when they resign, if that isn't in your accounts, you could all of a sudden be up for $50,000, $100,000, and you had no idea about it. So do get your leave into your accounts. And then the final point there is I think it's compulsory now for all businesses to be using single touch payroll. And we've seen errors where people are moving across from their old pre-single touch payroll days into this new type of reporting. Just make sure that's done correctly. Okay. So again, I've talked about all the things that you should avoid or shouldn't do. Here we've just got some tips from startup CFOs. So we work with a lot of startups and a lot of CFOs of those startups, and we just had a chat to them and just say, look, what are kind of your tips for founders and for startups? And that's what they've come up with. So the first one there is time is money. Decide what to do yourself and what to outsource. That doesn't just relate to your accounting function or your payroll function. It's anything really as a startup founder. What are you going to do yourself? What are you going to try to do yourself? And what are you going to pay for someone else to do? Second one there, this one's really important, cash flow. Cash flow, you've heard the expression cash is king. Cash flow management is really important both before and after a capital raise. Okay, you need to know, before a capital raise, even before you even start it, you need to know how much have you got left. How much will your current funds last you? And then even after you've raised the money, you need to know what your runway and your burn rate is before you'll need to do another capital raise. The third point there, it sounds simple, but again, I've got it there because a lot of people just don't do it. One, create a budget, and two, actually update the budget. Regularly update it to compare your forecasts with your actual income and expenses. Be clear on what milestones you want to achieve and when you want to achieve them. You may have a target to set acquire a certain number of customers by a certain date, or you want to be at a certain stage of product development. Have clear, tangible goals or milestones on what you want to achieve and when. And the last one there, this is an interesting one. The CFO and the COO role of a startup, they tend to have really similar roles. And it's different to your larger corporates where a CFO is a different person to your COO. When you're a startup, you may have heard the term FinOps, finance and operations. Again, those roles are becoming more aligned and merged together. And a lot of times it's one person that's responsible for both of those. So that's important for your hiring process if you're looking to bring on a CFO. A lot of the CFOs of the large corporates, they just don't get that. They don't understand that. So if you can bring on someone who's had experience actually working with startups as a CFO / CEO / FinOps, that's very important. Okay, raising capital. Now, when it comes to raising capital, here's our tips. Okay, so the first one there is to do your homework on each investor and what they're looking to invest in. Okay, now this is important because you're looking for something out of an investor. An investor is looking for something out of the startup. Okay, some of them may have a focus on legal tech, whereas other ones might be more fintech or ag tech. Some investors have an idea in mind of when they want to cash in, when they want to realize their funds. Does that align with your interests? So do your homework on each investor to see what they're looking for. Once you've done the homework and you've met with the investor, actually get to know them first before asking them for money. Okay, it's like dating. You wouldn't ask someone to marry you on the first date, and likewise, you wouldn't say yes if someone asked you to marry them. Okay, a big turnoff for investors is the very first time you meet them, you ask them for cash. Build that relationship first. Demonstrate a focus on the targets and the metrics, not just the big idea. Everyone's got a big idea. Okay, the difference between a successful startup and one that fails is the execution of the idea. So show that you're more than just the big idea. Show them how you're actually, that idea is going to be executed. Give them numbers, give them targets, give them metrics. Investors look at the team, not just the product. So if you've got a core team, if you've got a core C-suite team there, that investors tend to look on that more favorable than someone who's just a sole CEO and founder, and you tell them, oh, I'm looking for my CTO, I'm looking for my CFO. Make it easy for investors to see the return on their investment as the business scales. Give them forecasts, give them projections, and be realistic as well. Don't it's fine to give them different scenarios. Hey, if things go well, this is how our market share that we think we're going to have. If things don't go so well, this is what we think we're going to have. Be realistic with your with the projections. And the other one, the final point, I touched on it a little bit, is the capital raising process takes months. So don't start it when you need the cash. Start it well in advance of that. Okay. I've got a slide on here about ESIC, early stage innovation company. A lot of startups, you can't talk about capital raising without talking about ESIC. For those of you that aren't aware or never heard of that term before, the ESIC concessions were introduced in about 2015 or 2016. And if your startup is an ESIC, it provides concessions to your investors. Okay, so your investors can get a 20% tax offset for the amount they invest. So if they put in $1 million into your startup, they get $200,000 back from the ATO. Okay, and that's not even the cherry on top. The cherry on top is if they sell the shares within 10 years, completely tax-free, no matter how much the shares are worth. Okay, so if your company can be an ESIC, it doesn't kill a deal. It's not the be all and end all of things. It's more just that added sweetener that might just get that additional investor over the line and set you apart from other startups. There's a few different ways you can be an ESIC, 2 ways, either the 100 points test or the principles pace test. I'm not going to go into details of what those are. Just be really careful with what you say your investors. A lot of people I know, a lot of founders, they just rely on the 100 points test and they say, yep, we've set aside the 100 points, therefore we're an ESIC. The 100 points test is the I in ESIC, it's the innovation. You still got to satisfy the E and the S, which is the early stage. Okay, a lot of people overlook that. Timing is crucial. You could be an ESIC in 1 year, but not another. And ESIC only applies to shares. Okay, your investors won't get the benefit of an ESIC if they give you safe notes or con notes. They'll only realize the benefit once those safes or cons convert into shares. And if that's a few years' time, the company could easily not be an ESIC by then. Now, best practice, please speak to your accountant or your tax advisor about ESIC. What you can do and what we recommend is you provide your investors with a sign-off letter from your accountant saying, yes, our accountant has analysed this for us, and here's a sign-off letter saying that we're an ESIC for this financial year. You give that to your investors and they can rest easy. A sign-off letter is recommended for the 100 points test. If you're looking at the principles test, an ATO ruling is always recommended. So if you've got questions about that, let me know. And similar to ESS, ESIC has annual reporting that needs to be done. So you don't want to stuff that up because the ATO is going to use your ESIC report to data match it to your investors. So if you're saying your investors invested this much, but then in their personal return, they're showing a different amount, that's just going to raise red flags with the ATO. Okay, what we're going to spend a little bit of time on now is R&D and some other government grants. R&D is important for startups because it's Australia's largest, it's the Australian government's largest grant funding. It costs them about $8 or $9 billion a year. And for startups, we all know that banks aren't going to lend to you, and the R&D is often the biggest source of attracting non-dilutive capital as well. So the R&D, if you're eligible for it, you can get you can subsidize 43.5% of your costs. I'm not going to talk about what R&D is and what is an R&D. I'm just going to talk about with a focus on R&D planning. Okay, R&D planning is important. So it's not like you get through the income year, and then you go chat to your accountant about, or your R&D advisor about doing the R&D claim. You want to make sure that they're working with you throughout the year as well. And there's two main reasons for it. One is the benefits of R&D planning. Firstly, it maximizes your claim because you can identify what your core and supporting activities are and then allocate all the different types of expenses to those. And two, it minimizes risk. And the reason being that it gives you enough time to integrate your documents, integrate R&D with your existing software as well to show that you've kept documents throughout the year. So if we talk about documents, the key thing here from an R&D perspective is that documentation needs to be contemporaneous. Contemporaneous means in existence at the time that the R&D activities are being conducted. Okay, so that's why it's important that you work with your R&D advisor throughout the year so you can keep that documentation in place. The main area of focus by the ATO is employee timesheets. Okay, if your CTO is on a six-figure salary and you're claiming 80% or 90% of their costs of their salary as R&D, you're expected to keep timesheets. Timesheets is a very foreign concept to many people, probably not to Stephen and other lawyers. Lawyers and accountants are the two professionals that know what timesheets are. But for everyone else, employee timesheets is it's something they don't really come across, but it's what the ATO and Oz industry expect to see. So employee timesheets that are kept and updated throughout the income year as well. Areas of focus, other ones are experimentation and contractor agreements as well. So if you're talking about different types of R&D activities, those R&D activities should be in your contractor agreements. Okay. Now, biggest takeaway, one of the biggest tips is make sure that whatever you have as your core and supporting activities, the titles of those, make sure you use those in your project management software, whether that's Jira, GitHub, Trello, whatever it is. Make sure you use the same descriptions and also keeping track of the amount of hours that people are spending as well. Okay, so that way, you can link your R&D application to your own internal records. Other types of documents there that I've got listed, project plans, progress reports, source code documents, anything to show the experimentation and R&D that you've conducted throughout the year. Okay, some tips and traps. JobKeeper. JobKeeper reduces your R&D. Okay, you can't double dip on that, so just be wary of that when you're doing your cash flow forecasting. If you've received JobKeeper in relation to your R&D employees, those amounts you'll need to they'll come off your R&D refund. Instant asset write-off. So if you've bought assets, computer equipment, hardware, whatever the case may be, if you're looking to write those off or fully depreciate them, there's a right way and a wrong way to do it. It's something that a lot of R&D advisors are not across because it's a tax-centric concept, and accountants should be across it. But just keep in mind that there's a right way and a wrong way to do it. Not all software dev is eligible for the R&D tax incentive. When people, and founders in particular, when they think, yep, I'm spending all this money on R&D, look, that could be true, but the R&D tax incentive, what you're going to get your grant, what your grant is calculated on, it doesn't look at your entire R&D. There's certain chunks of that are going to be eligible, and there's certain chunks that are not going to be eligible. Okay, the back end, that's where your R&D tax incentive is going to lie. Your front end, like costs associated with your UI or your UX, probably not. If you've received the refund, you've lodged your R&D claim, you've lodged your tax return, and you've gotten the money back, just keep in mind that the ATO can review R&D claims for up to 4 years after lodging. Okay, so it's not one of those ones where, yep, I've lodged it, I'm all clear, I can put my head in the sand. And then the final point I've got there is do recommend that you you get holistic R&D and tax advice as well. There's a lot of R&D advisors there who are just R&D advisors. They're fantastic from a software perspective. They can speak your language better than what accountants and tax advisors can. But at the end of the day, keep in mind that the R&D tax incentive is just that. It is a tax incentive, and you need to see how the R&D fits with the company's overall tax profile as well. Okay, government grants. I'm just going to spend a few minutes talking about some of the other ones. If you're based in New South Wales, there's the MVP grant, the Minimum Viable Product grant. It's available to pre-revenue companies, and it's up to 25K in matched funding. This is one of the easiest ones to get. It's one of those government departments where they love giving this grant out. And if you're interested, I can make an introduction to the relevant person there. For those of you that are based in Victoria, I do know that as part of the lockdown measures, there was a suite of new grants that were announced by the Victorian government. I don't believe there's an MVP specific one, but I believe there's one that's similar to that as well. So if you want to find out more, there's somewhere where you can search on it. I'll come to that in a moment. The other one, EMDG, if you're looking to go global and take your business overseas, the EMDG is the main type of government grant. It reimburses it's match funding of your eligible export, promotion and marketing expenses. Just keep in mind that the EMDG scheme changed from 1 July this year. It's not what it was like before. Now you get grants of up to 40K, 80K or 150K, depending on what stage of your export journey you're at. Maximum of 8 grants that you're allowed. Applications are always reviewed. And importantly, applications for both years, so last year's 2021 year under the old rules and this 2022 income year under the new rules, applications for both of those close 30th of November. Okay, so get moving if you're looking to apply for that. The EMDGs, in addition to R&D, are the 2 grants that I help out with and advise companies on. Your AC grant, you've probably heard about this one. This is the big one. You can get up to $1 million in matched funding. Just be mindful that it is a competitive grant, and there's only a few of them that are given out each year, and it's a really long and onerous process, 3 to 6 months, and you could easily spend over 100 hours on this, putting your documents together, interviews, applications, etc. High risk, high reward. I do know businesses that have spent over 100 hours and not gotten a single cent out of it. And on the other side, businesses that have gotten the entire $1 million as well. If it's something you're looking to apply for, I can make an introduction to someone at the AC grant department. They're government facilitators. They're people you speak to that can help you on your journey. Okay, I mentioned before about searching for grants. There are hundreds, if not thousands, of grants available at both a state and federal level. No one's across them all. There's different eligibility criteria, like where you're based, the sex of the founders, like there's that Boosting Female Founders initiative, whether you're an immigrant or not. No one's across them all. Go check out that website, business.gov.au, grants and programs. See what type of grants are available to you. And then once you have a look, it then becomes an exercise of what's worth your time. Each of these has a cost, has a time investment. Does that time investment match with the amount of the grant that you're going to get back from that? And then that's up to you. Okay, and then the final area that I just wanted to talk about was, before we can go to questions afterwards, is international expansion. So where you're looking to take your startup global. Many reasons to go global, right? Maybe there's overseas investors, maybe you're targeting a particular customer market, you're trying to find the right employees, or maybe an exit or a listing is in an overseas area. How you go about setting up your company to allow for international expansion, there's two types of structuring that we typically see. An overseas subsidiary is the first one, where your Australian company is the head company, and that Australian company holds the shares in an overseas company like a US co. Or the other one is known as a flip up, where you've got an overseas head company, where a US co is interposed between the shareholders and the existing Australian company. Depending what you're trying to achieve by going global will have an impact on the appropriate structure. Generally, if you're looking to access a new market or hire new employees, an overseas subsidiary is the way to go. But if you're looking for overseas investment or to exit, because maybe the US is just where an exit is, it's the biggest market in the world. An overseas head company is probably the way to go, because US investors tend to want to invest in US companies. And I've put in brackets there, or status quo. Sometimes if you can try to get them to invest in your Australian company so you don't have to set up a new company, it'll save you a lot of headaches. An overseas subsidiary is by far the easiest way to go, because all you're doing is creating a new company that sits underneath your Australian company. If you're looking to do a flip up, that's much more complex, because the flip up process involves you as the shareholders selling your shares in the Australian company to the US company, and in exchange getting shares in the US company. So straight away you've got a sale, which means you're going to pay tax on that if you can't rely on certain concessions. So it's much more complicated to do a flip up. And that's why I've got some tips and traps in there, is be sure it's the right long-term structure. Make sure it's where you exit. Make sure it's where you see investment, because it's a really hard egg to unscramble. If you're going to do a flip up, where's your IP going to sit? Are you going to keep your IP in your Australian company? Are you going to move it overseas to the overseas company? Again, that has an impact on your eligibility to apply for Australia's R&D tax incentive, and also other overseas government grants as well. Think about the flip up process and the impact that has on your existing ESOP. So again, your ESOP and your plan rules should be able to cater for overseas investments and overseas restructuring. And then once you've got that overseas company, there's intercompany agreements that you're going to have to put in place, and strategies to make sure you're not paying any tax, more tax than what you have to. I've mentioned the landing pads program here. So if anyone doesn't know what that is, it's a program that's run by Austrade, and it provides startups with access to innovation hubs. You can see on the screen there, San Fran, Tel Aviv, Shanghai, Berlin, and Singapore. It's a 90-day residency period in a co-working space, and you get introductions to all these investors. Applications are open for future landing pads programs. So once international travel restrictions are lifted, those applications are open now. So do check them out if that's of interest to you. And then finally, other things you need to be aware of when you're looking to go global is you're expected to have intercompany agreements in place. So the typical ones we see there is a loan and funding and loan and interest agreement, a licensing agreement for your IP, service fees for use of assets. Keep in mind there's withholding taxes on certain types of payments to overseas parties. You may be required to register for VAT or value-added tax. So for example, in the US, there are some states where if you're selling at least $10,000 to residents over there, you're required to register for VAT. And it's crucial that you have got the right advisors in both jurisdictions as well. As soon as you go global, you're now a multinational company, and you need to have lawyers, accountants, and tax advisors in both jurisdictions to make sure that you can structure it effectively. Okay, so that's the end. I suppose that's the formal part of what I wanted to run through with everyone today. I've just left my contact details on there if you wanted to shoot me an email or scan that and connect on LinkedIn. But I am happy now to open the floor to any questions or comments, or is anything else that people want to have a chat about?
Alex, I don't have any questions, but I do have a comment. That was hands down the best presentation that I've had through this Law Hub, right? So I guess feedback for you and feedback for Landers. That was just really articulate, really on point, covered so many valuable lessons for us, and from my perspective, so many things to think about. So I can't quite articulate or formulate a question right now. I think I've got to sort of sit back and absorb some of that information, but I just wanted to say thank you. It was just, it was on point. Thanks very much.
Oh, Stuart, you're very kind there. That's much appreciated. And I will circulate the slides to Sarah, so then so all of you can grab a copy of that. I do realize it's a lot to take in. So yeah, have a read of it as well in your spare time.
Yeah, I just want to jump in and echo Stu's comments. I've taken like 10 pages of notes. And yeah, look, I think for me, I also need some time to digest it. I manage this aspect within our company. I am the COO, CFO that you speak of.
Yep.
What did I learn? What am I? I'm FinOps.
Yeah, FinOps.
And it's just been really great. Like I learned some new things. So I've, gone through and highlighted things I need to look up, and certainly things, Alex, that I'll want to chat to you about when we finally get to meet with Mick, hopefully in a couple of weeks. But also kind of realizing, like I am actually on the right track with this stuff as well. Like a lot of the pitfalls that you spoke about that we could, potentially not be doing. I'm like, oh, good. Well, we are doing that. So, we're on track in that way. So that's been really affirming. One question I did just have was around the early stage innovation company, the ESIC. I've literally never heard of that.
Yep.
And we are considering going down the path of a raise. And so I just wanted to know where I can go and find out more about that, and at least kind of do the 100-point or the 200-point test to understand that.
Yeah, look, as a starting point, go check out the ATO's guidance on that.
Okay.
It gives you a high level overview of what type of companies are going to be eligible for it. And if you think that's something that you could be eligible for, more than happy to have a chat and say, look, this is probably what you should or shouldn't be saying to your potential investors as well. So the things that will help you satisfy the 100 points test is if you've already raised money. Any 50k of shares, if you've lodged an R&D claim in previous years. Another one which you will be eligible for is you're completing or undertaking an accelerator program that provides time-limited support for entrepreneurs. So that's something there that you'll get 50 points just from being a resident of the Law Tech Hub. And also if you've lodged patents or other kind of IP like that as well. But typically accelerator, R&D, and 50k of shares being raised, that's where companies tend to satisfy the 100 points test. But yeah, have a look at the ATO's website and they'll be able to give you more info.
Amazing. Okay. Yeah, great. Thank you. Yeah, and I think any other kind of questions that pop up, I think I'll raise them more specifically when we finally get to catch up.
Okay,
so
fantastic.
Thank you. Yeah, great.
Any other questions?
I've actually got to run, but thank you so much, Alex. Like everyone else said, that was incredibly informative, and I will definitely be following up with you on a couple of those points you made.
Pleasure. Thank you, Shavin.
See ya.
Great. Well, if there's no more questions, thank you so much, Alex. The feedback speaks for itself. It was an excellent session. If you'd like to reach out to Alex and you didn't catch his details, they're on the Law Tech Hub website. And I will circulate the slides and the recording of the session in comms, which will come out later this week. Just a quick note, there was a reference to Aperian Law, which is now actually known as FCW Lawyers, and their details are on our Law Tech Hub website as well, so you can reach out to them. So thank you so much to everyone for joining the session.
Thanks, everyone.
Thank you.
Thanks. Bye. Thanks, Alex.